Hello and welcome to this video on private and public limited companies. By the end of this video, we should be able to differentiate between incorporated and unincorporated businesses, explain the advantages and disadvantages of setting up as a private limited company, and likewise as a public limited company. So let's just remind ourselves that we're looking at two groups of types of business here, unincorporated and incorporated. On the left-hand side, we have unincorporated businesses, and that is the sole traders and the partnerships. And the key here is the owner is the business. So in the eyes of the law, they are the same person, same thing, and therefore those businesses have unlimited liability. On the right-hand side, in this video, we're going to look at private limited companies and public limited companies. These are incorporated businesses, which means the business is separate from the owners in the eyes of the law, and therefore the owners of the business, the shareholders, have limited liability. Their personal assets can't be used to pay off the debts. They can't individually be sued because the business is separate in the eyes of the law. Let's start off by talking about what limited companies are. Limited companies are separate legal entities to the owners. The company can own things itself. For example, they can own assets like machinery or tools or stock. They can own contracts. For example, football clubs have contracts with their players. Modeling agencies have contracts with their models, and these are owned by the business. They're not owned by an individual person. They can employ people. The business itself can be sued, and the business itself can sue other people or other businesses. The companies are owned by their shareholders. The shareholders are the owners, and the company is run by a group of people called the directors. And the shareholders, the owners, appoint or put in place the directors who they want to manage their business. Shareholders own a share of the company, so they own a share, maybe 1 or 2%, depending on how many shares they have of the overall company, but they don't own the assets of the company. The assets of the company are owned by the company themselves. Also, they're not liable for the debts of the company. They have limited liability, so only their investment in the business can be used to pay off any debts. Their personal belongings, their personal assets can't be touched. How do you go about forming a limited company? Well, to form a limited company, you normally have to register your company with the government. And you will normally give some basic details about the company, such as its name, the objectives of the company, and the nature of its activities. Also, how much money you're investing in the company and how many shares it has. A second document you'll often give to the government is an Articles of Association, which sets out the rules on things like the voting rights of shareholders. Are we going to have some shareholders who have got stronger voting rights than others, or is everyone going to have a fair vote when we determine appointing directors or making decisions about the company? Once these documents have been submitted to the government, the business is issued with a certificate of incorporation, and that means it's a private limited company. Voila. Now, private limited companies are a type of limited company, and they normally have the words LTD after their name. And the shareholders are often the directors, so they run the company. So these tend to be quite, not massively huge international companies, but reasonable sized companies. And then the most common type of limited company is the private limited company. The shareholders are often family and friends. And the reason it's called private limited company is because you can only sell shares privately to other individuals. The shares are not available to the public at large. The existing shareholders get to determine who can buy new shares. In Greece, if you see a business with this at the end of its name, then that means it is a private limited company. If you do a quick search of the area, you can see lots of businesses that are private limited companies in the area, and this initial at the end indicates that the business is a private limited company. Let's talk about the advantages and disadvantages of being a private limited company. Well, the advantages are the shareholders have limited liability. Their personal items cannot be used to pay off the debts of the business. They can raise money through selling shares to other private individuals, and the owners can control who buys shares in the company. There may also be some tax advantages. Sometimes corporation tax, the tax that private limited companies pay, will be lower than income tax, which is paid by sole traders and partnerships. In terms of disadvantages, it's a bit more complex to set up because you have to register with the government. If you do sell shares to other people, then you lose some control, as they'll have some rights over voting about decisions the business might make. And also you can't sell shares to the public, so it might be harder to raise a huge amount of money compared to a PLC, which is what we're going to look at next. So whether to set up as a sole trader or a limited company, what might an individual consider? Are they willing to give up some control? If they're not, they'd probably want to stay as a sole trader, but if they are, then a limited company would be appropriate. The size of the business, often the slightly bigger businesses will become limited companies, where the smaller one-person businesses will stay as sole traders. What about the size of the market? Is it large enough to justify significant business growth? And therefore, would it be worth being a limited company? Think about the product itself. How risky is it? Is it very important to have limited liability if something goes wrong? In which case, you'd probably opt for a limited company. But actually, if the product's not very risky and there's very little chance of anything going wrong, maybe a sole trader would be a better option. And lastly, how much profit do you think you're going to make? Would you be better off paying corporation tax rather than income tax? So we've looked now at private limited companies. Let's finish off by looking at public limited companies. A public limited company, sometimes known as a PLC, have, as you would guess, PLC after their name. They are again owned by shareholders and run by a board of directors. But the difference here is that shares can be bought by members of the public. You can't control exactly who is going to buy your shares. People can then sell their shares again to someone else on what's known as the stock market. So if you had shares in, let's say, a bank like HSBC, or you had shares in a company like Vodafone PLC, you could then sell your shares through the stock market to someone else, and the business wouldn't be able to do anything about that. Shareholders are paid dividends, what's known as dividends from the PLC's profit. So the share of profits that goes to shareholders is known as a dividend. How do you become a PLC? Well, you need to go through what's known as a stock market flotation. This is sometimes also known as going public, when the company's shares are offered to the public for the first time. The business carries out what's known as initial public offering. This is the process of going public and is quite costly and time consuming. So for example, they've got to hire an investment bank who will generate all the shares and the share applications for members of the public. The business produces a report including lots of detail about the business so that members of the public know exactly what they're getting into when they buy shares. Most shares bought during an IPO are bought by what are known as institutional shareholders, so normally quite large companies like pension funds, insurance funds. A company can only do a stock market flotation in the UK if it has at least £50,000 in share capital, and in other countries it's a similar amount. A recent example of a company that floated was Snapchat. So they wanted to raise money to grow their business, so they thought becoming a public limited company, selling shares to the public would be a good way of doing that. And as a result, they actually increased the value of the business to $24 billion shortly after they did their stock market flotation. What are the advantages and disadvantages of being a PLC? Well, one of the main advantages is it's impossible to raise very large amounts of money by selling shares to the public. It's easier for your existing shareholders to then sell shares if they want to get rid of them, because they can do that through a stock market, and the risk is spread across a large number of shareholders. A disadvantage, well, if there's a large number of shareholders, many of whom want to have a say on how the company is run, that might influence decision making. As anyone can buy the shares, companies are often at risk of a takeover, and that is when one of your rivals actually goes about buying shares off the public and ends up controlling your business. So that is definitely something to be very wary of if a business you're going to become a PLC. Another potential problem is that it means your accounts have to be published to the public, which means all your rivals and competitors and suppliers and customers can view your accounts and see how you're doing. And often there's a bit of a divorce of what's known as a divorce of ownership and control. Senior managers may pursue their own objectives rather than those of shareholders. And because there are so many shareholders, it may be difficult for them to make their voice heard. So in this video, we've looked at incorporated and unincorporated businesses, private limited companies, and public limited companies. Well done for staying to the end.